November 2022. Luna collapsed, FTX imploded. Bitcoin crashes to $15,500. Your portfolio? Worth $47,000 in November 2021. Now worth $10,500. You're down $36,500. You tell yourself you'll hold. Diamond hands. This is fine. It'll come back. 2 months later, January 2023. Still around $10,800. Barely moved. You're starting to panic. What if it never recovers? March 2023. Worth $11,200. You can't take it anymore. You sell everything. Lock in the loss. Swear you'll never touch crypto again. 1 year later, March 2024. Bitcoin hits a new all-time high, $73,000. Your portfolio would have been fully recovered to $50,000. October 2025. Bitcoin breaks $126,000. Your portfolio would be worth $86,000, nearly double your original investment. By today, January 2026, Bitcoin pulled back to $90,000. Your portfolio would still be worth $61,400, up 30% from where you started. But you sold at $11,200, locked in a 76% loss right before Bitcoin went on to smash through all-time highs and deliver 30% returns. This isn't a made-up story. This is what happened to thousands of people. Maybe this is your story right now. So how do you actually survive a crypto bear market? Let's start with the most important thing nobody tells you about bear markets. They last way longer than you think they will. You see the first 30% drop and think, okay, this is the bottom, time to buy. It's not. It drops another 40% from there. You think surely this is the bottom. Nope. Drops another 30%. By the time you reach the actual bottom, you've been wrong about the bottom 4 or 5 times. You're out of money, out of conviction, out of hope. 2018 bear market. Bitcoin peaked January 2018 at $19,700. Didn't bottom until December 2018 at $3,200. Took 11 months of continuous bleeding, down 84% from peak. But here's the part that broke people. The recovery didn't start immediately. Bitcoin stayed between $3,000 and $5,000 for another 6 months. 17 months total of pure pain. 2022 bear. Bitcoin peaked November 2021 at $69,000. Bottomed November 2022 at $15,500. 12 months, down 78%. Then stayed relatively flat until October 2023. Almost 2 full years of your portfolio doing nothing but making you feel stupid for holding. That's what bear markets actually look like. Not a quick dip and recovery. A slow, grinding, soul-crushing destruction of your net worth that lasts longer than your conviction. So the first rule of surviving bear markets? Understand you're in for at least 12 to 18 months of this. Minimum, possibly longer. If you can't stomach watching your portfolio drop 70 to 80% and stay there for a year, you need a different strategy. Because that's the reality of crypto bear markets. Now here's where it gets psychologically brutal. During the bear, everything you believed starts getting challenged. Bitcoin is digital gold. Then why is it crashing harder than stocks? Ethereum is the future of finance. Then why is it down 85%? This altcoin has amazing technology. Then why did the founder stop posting updates 3 months ago? All your bull market conviction evaporates. You start questioning everything. And that's when most people make catastrophic mistakes. Mistake 1. Panic selling near the bottom. You've held through 60% drawdown, 70% drawdown, but at 80% down, you can't take it anymore. You sell everything. Then it recovers and you miss the entire next bull run. This is how people turn temporary losses into permanent ones. But here's the flip side. The contrarian take nobody wants to hear. Sometimes selling is the right move. If you bought random altcoins during the bull and now they're down 95%, holding might not be smart. It might be cope. Because most altcoins don't survive bear markets. Let me give you numbers. Of the top 100 cryptocurrencies in 2017, only 30 are still in the top 100 today. 70 projects either died or became irrelevant. 2021 top 100, too early to know final survival rate. but by 2024, at least 40 of them are already down 90% or more with no signs of recovery. So the nuance is this: holding Bitcoin or Ethereum through a bear, historically smart. They've survived multiple cycles. Holding Doggy Lawn Come Rocket 2021 through a bear, that's not conviction, that's denial. You need to differentiate between projects likely to survive and projects currently on life support. Most people don't want to admit their bags are dead, so they hold them to zero out of stubbornness, not strategy. Mistake 2. Trying to time the bottom perfectly. I'll sell now and buy back lower. This almost never works. You sell at 60% down thinking it'll drop to 80% down. It does drop to 75% down, but you're waiting for 80%. Then it bounces back to 50% down. Now you're watching it recover without you. You panic, buy back in at 40% down, higher than where you sold. You just turned a 60% loss into a 40% loss, but with fewer coins. Trying to time bottoms is how people end up with smaller positions at higher prices, the exact opposite of what you want. Mistake 3. Averaging down on everything. It's down 70%, I should buy more to lower my cost basis. Sounds smart, works great if the asset recovers. Destroys you if it doesn't. Luna holders averaged down from $80 to $60 to $40 to $20. Then it went to zero. They didn't lower their cost basis. They threw good money after bad. Averaging down only works on assets that will actually recover. On dying projects, you're just buying more of something that's going to zero. Mistake 4. Doing nothing. I'll just hold and wait it out. This can work. Can also be a waste of 18 months. If you're sitting on stable coins earning 0% while Bitcoin is at $16,000 for 6 months, that's a missed opportunity. You could have been accumulating. If you're holding a diversified portfolio of 15 different altcoins and doing nothing, you're not being patient. You're being lazy. Some of those need to be cut. Mistake 5. Giving up entirely. You take the loss, delete the apps, swear off crypto forever. It's all a scam. Then the next bull market starts without you. You watch Bitcoin go from $16,000 to $126,000 from the sidelines. That's an 8 times move you missed completely. Hurts worse than holding through the bear. So what do smart people actually do during bear markets? What separates survivors from casualties? First, they get brutally honest about their portfolio. Not hopeful, honest. They ask, if I didn't already own this, would I buy it? Averaging down only works on assets that will actually recover. On dying projects, you're just buying more of something that's going to zero. Mistake 4. Doing nothing. I'll just hold and wait it out. This can work. Can also be a waste of 18 months. If you're sitting on stable coins earning 0% while Bitcoin is at $16,000 for 6 months, that's a missed opportunity. You could have been accumulating. If you're holding a diversified portfolio of 15 different altcoins and doing nothing, you're not being patient. You're being lazy. Some of those need to be cut. Mistake 5. Giving up entirely. You take the loss, delete the apps, swear off crypto forever. It's all a scam. Then the next bull market starts without you. You watch Bitcoin go from $16,000 to $126,000 from the sidelines. That's an 8 times move you missed completely. Hurts worse than holding through the bear. So what do smart people actually do during bear markets? What separates survivors from casualties? First, they get brutally honest about their portfolio. Not hopeful, honest. They ask, if I didn't already own this, would I buy it today at this price? If the answer is no, they sell it. Even at a loss, sunk cost fallacy kills people in bear markets. I already lost 80%, might as well hold and see if it recovers. That's emotional reasoning, not logical reasoning. If the asset is likely dead, selling at 80% down is better than holding to 95% down. That remaining 15% can be put into something with actual recovery potential. Second, they build during the bear. Not just hold, build. Learn about the technology. Understand what you're actually investing in. Figure out which projects are still shipping code versus which ones went silent. Most people speculate during bulls and do nothing during bears. Winners do the opposite. Study during bears, execute during bulls. Third, they dollar cost average intelligently, not blindly, intelligently. DCA works because you're buying more when price is low and less when price is high, but you need discipline. Set a fixed amount, every week or every month, same amount, same schedule, no emotions. If you DCA'd $100 per week into Bitcoin from December 2021 through December 2022, you'd have bought Bitcoin at an average price around $30,000. When it hit $126,000 in October 2025, you'd be up over 4 times. But most people couldn't do it. Because watching your weekly $100 drop 15% the week after you bought it feels terrible. you stop buying. That's why DCA requires discipline most people don't have. Fourth, they take advantage of tax loss harvesting. If you're going to sell at a loss, might as well get the tax benefit. In the US, you can deduct up to $3,000 in capital losses per year against regular income. Anything beyond that carries forward to future years. If you have losses, realize them before year end. Then you can buy back the same asset immediately if you want. Crypto doesn't have wash sale rules like stocks do. This is free money most people ignore because they don't understand taxes. Fifth, they protect their mental health. Bear markets are psychologically devastating. Your net worth is collapsing. You feel stupid. You're watching your dreams die in slow motion. Stop checking prices every hour. Unfollow crypto Twitter. Delete the apps if you need to. Check once a week, once a month. Your mental health is more important than watching red candles. Plus, obsessively checking doesn't change anything. Price does what it does whether you watch it or not. Sixth, they maintain dry powder. They keep some cash on the side. Not all in, not all out. Balanced. Because in bear markets, unexpected opportunities appear. A project you've wanted gets absurdly cheap. An exchange lists something at a discount. Having cash ready lets you capitalize. Going all in during euphoria and having nothing left during despair is backwards. You want reserves when everything's on sale, not when everything's expensive. Seventh, they ignore the noise. Bear markets separate people who understand the cycles from people who are just gambling on green candles. The hard truth? Most people watching this won't survive the next bear market. Swear off crypto. Then FOMO back in near the top of the next bull. The few who do survive, they'll set themselves up for life because they bought when everyone else was selling. They held when everyone else was capitulating. They stayed patient when everyone else lost hope. Bear markets aren't fun. They're not supposed to be. They're supposed to be hard. That's what makes them effective at shaking out people who don't belong. Your job isn't to enjoy the bear market. Your job is to survive it. Keep your capital intact. Keep your sanity somewhat functional. And position yourself to capitalize when the recovery comes. Because it always comes. Every single bear market in crypto history has eventually ended. The recovery always happens. The question is, will you still be there when it does?